Hey, afternoon Instagram, how are we getting along? And welcome to the third episode of the Monday Mortgage Melt. Now, before I get started, if any of you ever miss any of these live videos, you can always check out replays that are on my IGTV as well as on my YouTube channel as well, which you'll find in the link in my bio. So hi to everyone that's joined in already. Just giving you a little wave. So I am going to be taking questions. So any questions you've got related to property, mainly mortgages, property finance, development, bridging, commercial mortgages, whatever it might be, let us know. Hi Tom, thanks for joining in. But to kick things off before, let me just take a quick slurp from my massive The Boss mug. It's decaf, by the way. So after 4 o'clock, have to have decaf, otherwise it stops you from sleeping. Just want to kick things off with something that we've seen a little bit over the last week or so, which is all to do with commercial mortgages. So two things. I don't know how many of you are into commercial property that are watching this, but it's a big space and one that not that many brokers occupy. But we like to do our best to help clients that are investing in commercial property. And two things that come out quite regularly when it comes to commercial mortgages are the yield-based valuation and what type of commercial premises or property it actually is. Now, one thing that we've learned is from the yield-based perspective is even some of the most well-known commercial lenders at the moment are actually not doing yield-based valuations yet. Now, for those of you not in the know, a yield-based valuation, hi Rani, nice to see you. Thanks for the little wave. A yield-based valuation is when the value of the property will be based on the income that the property actually generates rather than what the bricks and mortar valuation would actually be. So if you're an investor and you're looking to pull as much money out as possible, it's sometimes quite good. Hi Steph, Stephen, hi Blix. It's quite handy to try and pull out as much money as possible, and sometimes the yield-based valuation, i.e., 10 times the annual income of a property, actually is going to work out to be higher than the bricks and mortar valuation. That's what the loan to value is based off. That's what the loan's based off. That's how much money you can pull out, which, when you're trying to build a portfolio, it's pretty handy. We see a lot of these on HMOs, larger HMOs. And what a lot of these investors will be doing is trying to, as I say, pull as much cash out of these HMOs on the back end. HMOs where they've got sui generis classification are really the kind of properties where these yield-based valuations tend to find themselves. However, as I was saying before, some of these lenders that typically would be looking at these yield-based valuations, quite normally in a normal world, your Shawbrooks, your Hampshire Trust Banks, some of them are getting a little bit scared by them, and I can understand why. If you think about it, we're being told that a dip is coming. At some point the bubble's going to burst and the market's just going to go into freefall. Now, whether you believe that or not, there's enough concern about it going on at the moment, unfortunately, which means that lenders are concerned that if they look at borrowing, a loan based on yield on a property, especially if it's a really highly income generating HMO, 7-bedroom or more HMO, it's likely that from a bricks and mortar perspective that even a small dip could push that property into negative equity from a bricks and mortar point of view, which does cause them some concern, which is understandable. However, having said that, there are still some lenders that are doing yield-based valuations, particularly on sui generis classified HMOs and other commercial properties. So if it's something that you need, if it's something that you need that as your exit out of this particular project, there are still lenders available. But this is the big but: do your homework. Don't just go with a lender for rate, go with a lender that can actually offer this type of valuation if it's something that's absolutely crucial to the success of your deal. That is the key. And on that point, I want to talk a little bit about interest rates, because I was talking to a good friend of mine, Alex Hearn from Sealants Hearn, quantity surveyors and project managers. Check out Sealants Hearn if you haven't already. Great company. We were talking about interest rates earlier on. We're talking about cost cutting. And one of the things I was telling him about was a presentation that I did last year to a group of property investors, all to do with property finance, and a few hints and tips. And it was less kind of like an update on what the rates were and stuff, but more sort of getting into your head, thinking about the mindset of it and how you should view finance to actually allow you to further your property journey, if you like, or grow your property business. And this particular slide, it was completely black. Apart from on one side, it had 3 percentages. It had 1%, 2%, and 3%. And I asked the audience, I said, right, which one of these 3 interest rates do you want? I said, put your hands up if you want the 1%. And everyone in the room put their 1% up. Put their hands up, sorry, for the 1%. I then clicked the little clicker and it revealed some white writing next to it, which said, only available at 40% loan to value. I said, how many people now still want the 1%? A lot of people put their hands down, a couple still there. Obviously, they've got big deposits. I said, what's next? Who now would prefer to have the 2%? So, everyone else put their hands up for the 2%. And again, clicked it and revealed the writing next to it in white, which said, unreliable underwriting, poor track record at actually completing deals recently, very tricky to work with their legal team. I said, right, how many of you still want that 2%, or would you prefer to go for the 3%? So there's a few people saying now, yeah, okay, let's have a look and see what 3% was. Opened up the 3%, clicked on the button, white writing again on the black backgrounds, it really stood out. And it said, reliable lender, will get the job done and will get it done quickly. And I said, right, let's start from scratch, leaving all of this up on the board. Which of you would go for the 1%? Well, I think one person put their hand up. Which of you would go for the 2%? No one put their hands up. Which one would go for 3%? Everyone else put their hands up. And I said, look, I said, any of you that know me, any of you that have spoken to me, any of you that follow me on any kind of social media platform at all know I've got this big bee in my bonnet about interest rates. And I don't do it because I want to come across like a knob. I don't say it because I want to continually say the same thing over and over again. I say it because it's so important, and I say it because I've seen so many people struggle because they just cannot get out of their own way. They can't get outside. Hi, Lauren. Welcome to the live. They can't get out of their own headspace. That actually the knob. Lol. Yeah. I'm 36. I still use the word butters. If anyone knows what butters means, then put your hand up or let me know if you know what it means. But I said that over the weekend and somebody laughed at me. I'm getting old now. 36 last week. But yeah, you need to. Interest rates are one of the biggest inhibitors to people being able to further their property business and grow their property business. But if you can forget that interest rates are the most important thing in the world, because they're not, getting the job done is the most important thing in the world, then you can actually start really, really, really growing your business. And I think it's just such a vital thing. So, look, I know I'm a mortgage broker, Grand Union Finance. Put that there for a reason. I think it looks quite nice. Let me know if you think that looks cool in the background. Little Grand Union Finance. Funny story about that actually. Quick tangent on how we came up with our branding. Now I really like the colour scheme. This was actually a colour scheme for a rugby team that I used to play for, that I used to design the kit for. And so I really like the colours. But I came up with a really sort of basic one, and I sent it off to somebody on Fiverr to just make it better quality. And she came back and she didn't read the brief, and she sent me 4 completely brand new logos that she created off the bat. And I got a bit annoyed. Like, this isn't what I asked for, blah, blah, blah. But I showed my wife, who you might be able to hear is hoovering at the moment. I should probably go out and help her in a bit. But I still use butters. Yes, I do too, Rani. Thank you very much. So she went, well, your one's crap, and that one that an actual designer designed is really good. So I actually went back to that designer and said, hold your horses, don't give me my crap one back. Just give me that one in the best quality you can, transparent, negative, positive. And that's how we actually ended up with that particular logo. And And I promised actually last week I'd talk about this. For my birthday, I received, not that's stuck to the bottom of my shoe, these trainers. And as you can see, pretty similar in terms of the colour scheme on these trainers. And so, yeah, it all kind of blends in together. I've got a light blue hoodie now, and sometimes I'll just have to Google butters, Lauren. Come on, Lauren. No way. You didn't have to do it. I'm trying to think of other words, like 90s words. If you were born in the early 80s like me, and you grew up during the 90s, what other kind of London words were going around? I can't really think, but going off on track. Those trainers actually, I knew that was the colour scheme, and I loved those trainers a lot. I wear skater trainers all the time, a bit of Grebo in disguise. I'm always wearing Vans, but those ones are Nikes, so maybe a bit more upmarket, I don't know. But yeah, they're my sort of my mini success of I'm now a company owner, so I can wear shoes that are in the colour of my company logo, which I think is awesome. But guys, if you've got any questions related to any kind of finance, property projects that you're looking at, any development finance, any bridging queries, anything like that, even if you just agree with me about the interests, pop me in a comment. You can ask a question. You can click on, there's a little I think there's a little question mark in the bottom. So any questions you've got for me, let me know. Another great word, I know Grebo. I think I was told once that a Grebo was somebody who dresses like a skater but didn't know how to skate, and that was 100% me. When I was a kid, I had the big baggy jeans and the hoodies, could not skate, never even jumped on a skateboard, but I certainly looked the part, shall we say. Had sort of longer hair back then, and didn't have a beard because you know I couldn't grow a beard until I was about 27. So now I'm just trying to make up for lost time, you see. But guys, I'm interested to hear what sort of property projects you've got on the go. Even if you're just starting out, you know, there's no such thing as a stupid question. If you just want to ask it by using a little question mark below, it's completely anonymous as well, so no one has to know that it's you that's asked a silly question. But another thing that's come up this week actually is talking. Hey guys, how we doing? Oh, Raj has just joined us. Hello Raj, how are you? Yeah, so what was the other thing that I was gonna talk to you about? That was it. Somebody asked me this week, why are limited company mortgages so much more expensive than normal buy-to-let mortgages? And I said, I must admit, my first thought was, actually, yeah, why are they? But it's actually, it's pretty obvious, actually, why they are. Because you've got another layer of ownership, okay? You've got yourself as the director, you've got the property, and you've got this limited company in the middle. There's extra due diligence. Not all lenders want to do it. There's actually probably more due diligence that even I or you or anyone would realise needs to take place. They effectively have to do their due diligence twice. Even if it is a brand new company, they can, lenders lend to brand new SPVs all the time, but that's not going to work within their criteria. Like, oh, well, if it's it's a brand new limited company, there's less due diligence, so we're going to lend, we'll lend on a sole basis because there's less due diligence to do. They're not going to do that. It's one or the other. It's black and white. Either it is a limited company or it's not. So all of the due diligence that they do with regards to any kind of limited company, because you imagine it's a limited company that's been going for 10 years, they might want to look at the history, they might want to check for charges, they might want to check for defaults, they might want to check for the accounts, make sure that they're all looking good, they're all up to scratch. And so there is a lot of extra work that goes into it. And this is why, actually, and this was one of the answers I gave, was if you think about it, you look at the high street, NatWest, Santander, Barclays, Nationwide, these guys, well, Nationwide's not included actually because the mortgage works do lend to limited companies, but those other banks don't lend to limited companies. Why? Because they don't want to. It's too much like hard work. Thanks, Raj. For anyone that isn't following Raj, go and click on her name now, and you should definitely go and follow her because she's fantastic. Not only a guru when it comes to service accommodation, but she's a fellow mortgage broker like me. So we need to spread the love. Everyone go and follow all the mortgage brokers and advisors on Instagram because it's a lonely world for us brokers. We're always told that we're wrong all the time. So spreading the love. Go and follow Raj. But yeah, going back to what I said about limited companies, when you think about it, there's actually a really good reason why it costs a little bit more. Smaller market, less competition, always going to drive up prices, but the fact that there is actually a lot more work that needs to get done. If you think about it, you wouldn't quibble but for having to spend more on an interest or having a higher interest rate if you were an expat. Well, I say that quite a lot of my clients do quibble about that. Why can't I have the same interest rate as John Smith, who lives in central London, just because I live in Singapore? Well, it's because you live in Singapore, mate. That's the reason. And there's a very small pool of lenders now that lend to expats and foreign nationals. And so, it causes, it means that they've got to do extra work. It's as simple as that. We've got a question. Shall we have a little look? If you buy a property with 100% cash, is it harder to refinance onto a mortgage rather than buying with a bridge? The answer is actually yes, surprisingly. So the way I always describe this to people is lenders, I don't want to say lazy. They're not lazy. Lenders aren't lazy. But if they can find an opportunity to do something easier, then obviously that they will, just like anyone. So think about it from the lender's perspective. You are refinancing a property and you're paying back a bridging loan. Now, when that property was purchased, that bridging lender was under an obligation to do anti-money laundering checks to ensure that you were purchasing the property correctly and you weren't laundering cash, basically. Now, if you purchase with cash, yes, the solicitor should still be doing those sorts of checks, but the mortgage lender is probably less inclined to rely on this as heavily. And so it means that they've got to do their own checks, which a lot of them don't want to do. So take Kent Reliance, for example. Kent Reliance are a really great mortgage lender for refinancing from a bridge. If you're doing BRR, you're refinancing, you're buying, you're renovating, and then you're refinancing. If you want to do that before 6 months, Kent Reliance will do that open market value all day long. They're a great lender for that. But they won't do it if you buy cash. So that was quite a long-winded answer to your question, which is yes, it can be trickier, but only really when you're trying to refinance quickly. So if you're trying to refinance before 6 months, it's tricky. After that, it's not really too much of a problem. I surprisingly say to my clients, only borrow what you need to. There's a couple of things to think about there. Number one is I always say, you only borrow what you need to, so keep your cost of funds as low as possible. The lower the loan to value, the cheaper the funds are going to be. The lower your cost of funds overall, the more opportunity you've got to make more profit because there's less outgoings during that project. But at the same time, you also need to be wary of how much money you've got sitting in your own bank account to take advantage of other opportunities that are coming your way. If you've got all of your cash chucked in with a particular project because you've gone really low on your loan to value, or you put in a big deposit, then it means you might struggle with the next project. So there needs to be a balance with that. And what else was I going to say with that? It's a strange thing coming from a mortgage broker saying don't leverage too highly, but I'm a big fan of not over leveraging because I just think it eats into your profit. And sometimes you need to do it when you're starting out or when you're moving from like one sort of level of project to the next. It can be a bit tricky, but always really have a real look at the figures and make sure it's going to work out, especially if you are leveraging high. But got another question coming in. Hello, should I open the Liberty Company to buy my first house that I will live in as well, or just for the ones that I will buy to rent later? So okay, there's a tricky one on this. So I can actually give you an example. I worked with a client a couple of years ago who had moved over from overseas many moons ago, 15 odd years ago, was now a relatively wealthy individual. But when he first came over to the UK, he was recommended to purchase a property in a very particular way for him to live in by his then accountant, tax advisor, whoever it might have been. And what they did was they purchased this property, and get this, right? It was owned by a limited company that was registered in the Channel Islands. I think it was Jersey. And that company was held in a trust that was based in the Isle of Man. So get your head around that if you can. We were talking earlier on about due diligence when you've got levels of ownership. Yeah, most people couldn't get their head around that. Now, the problem we had was there's no lenders. That was unencumbered. He didn't have, that means there's no mortgage, by the way. There was no mortgage on this particular property. And so we needed to raise some finance because he needed it for he was going to expand his portfolio, but also he actually needed to pay to get this what we call de-enveloped. What it means is get rid of those structures and just bring it back to sole ownership. He was going to have to pay stamp duty, he's going to have to pay legal costs, he's going to have to pay tax advisor costs. It was going to run into the many thousands, and we needed to raise some cash to pay for all of that just to get it good. So my advice to you, in fact, it's not my advice, I'm not a tax advisor, so I can't give tax advice, but from a lending perspective, lending to a limited company, which ultimately would then be renting the property back to yourself, Bernard, is going to be hard, okay? It'd be really, really tricky to do that. So I would suggest probably not, unless there's a very, very, very good reason to do so. So I really hope that helped you out. We've got a couple more questions coming in now. We've got a few coming in. What if it's 100% investor cash? Okay, good question. That doesn't really make too much of a difference, to be honest with you. That will still be treated in exactly the same way as it would if you were buying 100% cash yourself, to be honest with you. So that's a quick and easy one. So let's move on to the next question we've got. If you move home, do you need to update land registry for houses owned as a buy-to-let? No, you don't. It's all about the ownership with land registry. So you would, if you're moving, you're obviously going to be purchasing another property, and it's going to be owned by you or your limited company or whatever it might be, an LP. It could be any old thing. But you don't need to then notify the land registry that it's going to be a buy-to-let property instead of your own. It's just about the ownership. There'll be charges that they'll be able to see on there, but to be quite honest, the land registry are not interested in that. It's more the FCA that are worried whether you've got the right finance on it and whether you've got the permission to let that property or not. So it's about having the right mortgage on it rather than notifying the land registry. But I hope that answered your question. Let me know if it did. Incoming day one, set out the 3 codes, use the question. Oh, this is Raj trying to help me out. So Raj was talking about sort of using the right SIC codes, I believe, Raj, and you can tell me if I've got this right or not. So effectively, when you're setting up a limited company to take ownership of your property or your project, depending on where it's at, you need to be aware of the type, number one, the type of limited company it is, and then what the SIC codes are, so the nature of business. When you go on Companies House, you look on company records, right at the bottom, there'll be a little section that says SIC codes. And you need to be really, really careful that you've got the right SIC codes in place. So basically, let's keep things simple. There's 2 different types of limited company. It's a trading company. So for example, you go down to Greggs. Greggs is a trading company because Greggs buys a load of ingredients, turns it into the best sausage roll that you're ever going to have, and then you buy it. It sells it to you. It's a trading company. When you buy a property, you do it up, you sell it on, it's a trading company, okay? So the other one is an SPV, a special purpose vehicle. Now the reason the special purpose is that it's there just to own assets. It doesn't need to just own property, but owns assets, and it's non-trading. You can't trade, you can't have a trading business running through a special purpose vehicle. Now, limited company mortgage lenders do not like lending to trading companies, they like lending to SPVs. And they like to lend to SPVs with the right SIC codes attached at the bottom. Now, I can't remember all of them off the top of my head, and they vary a little bit from lender to lender, but essentially they're the ones involved in buying and letting property, real estate, property management, property lettings. They're the ones. Your accountant can help you out with that. But most lenders will have a list of the ones they accept, but here's the ticker. I recently, about 4 years ago, had a bit of a problem with a lender who wouldn't lend on through a particular limited company because the SIC codes were wrong. So what we did was we decided to change the SIC codes. Fairly straightforward, you might think. No. The lender still didn't want to lend on the property because of the historic SIC code. So you need to get it right first time around. Otherwise, it can still cause you some problems. Now, where this has caused some problems for some of my clients more recently, actually as well, is when they might be buying a site to develop, and the initial idea, the plan A, is to sell it. So they want to sell it. The exit strategy is selling it all. It's basically a flip, but is in a bigger capacity essentially. But halfway through, you're like, market's not fantastic, might not be able to sell all of these units, all these flats, all these apartments. Why don't I try and keep some? Well, you probably bought that in a trading company. You can transfer those assets into an SPV, but you need to get really solid tax and sort of legal advice on how you can do that. But again, you need to make sure that new SPV has all the right SIC codes attached. So it's really, really important to understand that. So hopefully that's helpful for you. Let's have a look and see what else we've got. Question wise, we've got title deeds record the owner's address. Not sure if they use that for any correspondence. No, it should be updated. The address is going to be what's on the electoral roll usually. I think Blix, but I might need to double check that. But that's my understanding anyway. Let's see if we have. I think I saw another couple of comments come up. No, I think we might be all done in terms of being up to date with questions. Any other questions? Got a couple of minutes left, probably got time to take one or two more. But look, I hope this has been really helpful for you in the meantime. I do these Monday mortgage melts as the name suggests every Monday. I did it on Tuesday last week because we had a bank holiday. But about half an hour every Monday, just talking about mortgages, my favourite thing to talk about, and obviously inviting questions from yourselves. I do put these on YouTube, so if you do miss them and you prefer to just sit in bed and watch it on YouTube, you can do. So this will be up probably this evening on my YouTube channel. There's a link in my bio for that. And of course, if you don't already subscribe to me on Instagram, do so, because pretty much every single day, well, I say pretty much, I can't remember the last time I didn't post something. I pretty much post. I do post every single day without fail on Instagram. This will be going up on my IGTV. I've also got a new reel that's going to be coming up as part of my little series that I'm doing of sarcastically saying things that mortgage brokers love to hear. So I've had 2 of those so far, and I've been getting loads of comments of people finding it really, really funny. But there is a seriousness to it. You know, these are things that us brokers just go, ugh, every time we hear it, because it's the same thing over and over and again that we hear. And so, got another one of those coming out about 8 o'clock tonight, and lots more content coming your way. But I think we're all out of questions. So thank you ever so much for all of you that posted your questions. Thanks for listening. Thanks for watching. And hopefully I'll catch as many of you as I possibly can next Monday. In the meantime, have an awesome week, guys. I'll catch you later. Bye.